Let's move on to step number 4 of our financial freedom journey here. Invest for the long term, that is compounding and dividend income. Financial freedom isn't about saving what is left, but it's about investing first and letting time and compounding do the work. Traditional advice is invest 50% of your income, not 40%, not 18%, 15% into retirement account. That's a solid discipline. However, there is a modern version. Invest at least 15% of your income, not the retirement, but for freedom. Because the earlier you start, the sooner your money stops working for someone else and start working for you. The power of compounding and dividend income, as illustrated here, I have built a portfolio that generates around 30,000 per year in dividends and 8,800 in interest income. That's about 3,200 per month, covering many recurring expenses without lifting a finger. And the 30,000 per year and 800 in interest income, that is 2,500 month in dividend income from quality stocks and ETFs, and 740 month in interest from fixed income and high yield savings. That's 38,800 per year of passive income. And it keeps growing every year thanks to reinvested dividends and compounding returns. Your goal: get to a point where your money works full time for you, even if you don't work full time. There comes the question of where to invest that 15%. Don't just stash your money in cash or savings. Invest it in strategically across quality dividend stocks such as Johnson and Johnson, Procter and Gamble, Microsoft and Pepsi company. On my channel here, there are few videos that I have posted. You can also take a look where to invest the 15%. The best 100 stocks to buy in 2026 series, best stocks to buy right now, and best or top 23 AI stocks to explore in 2025. About 11 months ago, the video is on my channel. I had predicted 50% upside for Google. Google was at around that time 165, and I had predicted about 50% upside. But right now, Google is at about 260 as of October 2026, which is $100 more. So it has passed even 50% that range. Google at that time was about $160. And in 11 months, Google has reached to 260. My prediction was just 50%, but Google has even surpassed that particular figure. So the point of our discussion here is invest in a quality stocks and ETFs that are unique. They have a wide moat and which are unique in their services and offerings to the not general public in US or in North America, but at the global level. If you are just looking at just the traditional high dividend ETFs, here are some of the examples: SCHD, US Dividend Equity ETF, YVM, Vanguard High Dividend Yield, and JP Morgan Equity Premium Income ETF. These are just example, but you will find many other examples with the high yield dividend distribution ETFs on my channel. Within our step number 4, there is another area that you can also invest is a broad market ETF for growth, such as SPY, VOO, VTI. That's the US total market exposure, and a VEQT, XEQT in Canada. SPY is particularly, I would say, is the best because it has the 500 all US best companies in within the S&P 500. VOO VTI again is gives you the total market exposure, and those also something that you can take a look. And again, you can also have the interest income from cash and bonds, such as treasury bills, bond ETFs like BND, AGG, and high yield savings account, which gives 4 to 5% currently. Then another thing within this step number 4, within the compounding and dividend, is to put your money within the tax efficient investing accounts. If you are in the US, maximize your IRA or 401k accounts. If you are in Canada, maximize your RRSP, that's the registered retirement savings plan. Again, if you are located in any other places such as the Europe or Asia or other countries, you might have the similar accounts such as the retirement savings account or the accounts that are like a tax free accounts. Again, here we are coming back to Canada and US, and both countries contribute fully to your tax-free accounts such as Roth IRA in the US or TFSA, that's a tax-free savings account in Canada. So again, your 15% plus Some of the contribution, or I would say maximize your contribution into your Roth IRA or TFSA. But don't leave that money sitting idle in cash or money market funds. Inside your tax-free account, invest it in a smart way in S&P 500 ETFs, total market ETFs, and dividend stocks that pay you to own them. That's how your tax-free account becomes your freedom account, where wealth compounds quietly while you sleep. Here is an example: the 15% freedom rule. If you earn 100,000 a year and invest 15%, that's a 15,000 annually at 10% average return. In 30 years, that becomes 2.6 million. Even with a modest 4% dividend yield, that's 104,000 per year in passive income. That's how you retire early, not by saving, but by building income that never stops.